Well, greetings and salutations, Series 7 test takers. This is the Series 7 guru coming to you from my off-grid studio, getting our kicks on historic Route 66. I have a very popular video that has contributed to many, many testing victories called Your Series 7 in 60 Minutes. And people have been asking me for many, many, many months to update that video. It's still relevant, it's still appropriate. And I didn't want to make a Series 7 and 60 Minutes part two, right, or part two. So I thought instead I would continue to build out updated versions of those, which are we're now calling the Mighty 90. So this is your Series 7 in 90 minutes, the Mighty 90 on the Series 7 to get you in the flow night before or morning of your exam, or both. This isn't designed if you are listening to this video and you don't know these things, that would be bad, right? So this is a flyover before you stick the landing tomorrow on your Series 7. All right, let's get our 90 minutes, the Mighty 90, starting with types of communication and the distinction on your exam about retail versus correspondence. So you should know correspondence is 25 or fewer, and that your principal can approve that pre or post distribution. That's a 30-day period, right? That's correspondence. Retail communication is going to be more than 25, and that requires principal approval pre-distribution. What else would require a principal approval? Well, remember in the options account, the registered option principal would approve that account. And once that account is approved, the customer has to have back to us within 15 days of that account approval, the option agreement, right? That they read the booklet, they understood it, all that kind of stuff. They understand what level they've been approved for. In terms of capital markets and underwritings, if we're doing a traditional initial public offering, we're going to make our registration statement. We should know that once we enter into that registration statement, make that registration statement, we enter into what's called the cooling off period, quiet time. You should definitely know that's a minimum of 20 days. You should know that during the cooling off period, we're trying to make sure that all the information is truthful, relevant. Most importantly, we've made no omissions of material facts. During that cooling off period, we can send you a red herring, also known as a preliminary prospectus. It has pretty much everything you need to know except the final offering price. Based on that, we can accept indications of interest, IOIs, which are non-binding on all parties. We're not allowed to advertise the new issue, but we certainly can place a tombstone. A tombstone is just a matter of record, right? A tombstone says it's neither an offer to sell nor a solicitation to buy the following security. An offering is made only by a copy of the prospectus. Make sure you understand which documents are which, right? So the underwriting agreement is between the issuer and the underwriters. The selling group agreement is between underwriters and their selling group members, the selling group members that are in that underwriter's bracket. And remember, selling group members are never liable for unsold securities. Only syndicate members are liable based on whether it's divided or undivided. Divided is also known as Western, undivided Eastern, right? So it's either going to be individually responsible or based on percentage participation. We have to make sure just because we've registered with the SEC doesn't mean we're necessarily okay in the state, right? So securities need to be blue skied with the state administrator through either coordination. That's the same time we're doing our IPO or 33 registration. If we're not doing 33, then we would qualify that security through qualification with the state administrator, registering the securities with the state. If it's a federally covered security, we can make notification. Again, the idea here would be there's a whole laundry list of exempt securities. I wouldn't worry too much about that. Now, in munis, if we're going to do a muni underwriting, remember that's either going to be negotiated or competitive. In a negotiated transaction, the issuer selects the underwriter. In a competitive transaction, the issuer is going to publish a notice of sale. A notice of sale means it's a competitive underwriting. Attention, investment bankers, we'd like help selling these securities. That notice of sale is going to be published in the bond buyer. The bond buyer is a newspaper widely read in the municipal market, right? You should definitely know that in underwritings, the difference between what the investors pay and the issuer receives is the spread. Spread always means difference. Whether it's the bid and the ask, whether it's the NAV and the pop, whether here it's what the issuer receives, what the investor pays, whether it's difference in the premiums, that's what the word spread means. Now, in terms of components of the spread, you should know that the management fee is the single smallest individual component of the spread. And the selling concession is the largest individual component of the spread. Be careful in munis. The total takedown is not an individual component of the spread. So if they say largest component in munis, it's the total takedown. But please note, that is not an individual component, right? We talked about that. What about some exempt transactions we should be aware of? We should be aware of the definition of a QIB, a qualified institutional buyer of securities under 144A. That definition is they have assets under management of 100 million or more. And what they're allowed to do is buy unregistered foreign and domestic securities. We should know that another definition we're held accountable for is an accredited investor who can accept an invitation to a Reg D private placement. Good way to remember that is 1, 2, 3, right? 1, $1 million net worth exclusive of primary residence, or $200,000 for the last 2 years, with the expectation 200 grand this year, or married and filing jointly, 300 grand for the last 2 years, with the expectation of 300 this year. 1, 2, 3. I got some good news for you too. Once you pass your Series 7 and you're a Series 7 in good standing, you too meet the definition of an accredited investor. Another exempt offering, exempt transaction, how we're selling it, another safe harbor is Reg A. Regulation A has 2 tiers. We have tier 1 up to $20 million, tier 2 up to $75 million. The difference between tier 1 and tier 2 is if I go into that, tier 2, then it becomes suitability. I shouldn't say suitability. Yeah, well, we'll use that word for lack of a better term. And then you can only put 10% of your net worth or 10% of your annual income into a reg offering. That is a public offering, exempt transaction, safe harbor under 33. And we go to that second tier, they're going to have to have audited financial statements, the issuer. We should know the distinction between under Reg D 506B, where we can have up to 35 non-accredited investors, but we can't solicit, and 506C, where we have no, Reg D 506C, no non-accredited investors, but we can solicit. 147, an exempt transaction, is an intrastate offering of securities. For us to use this exempt transaction, this safe harbor, without registering under 33, right? S1 is I wouldn't worry about it, but S1 is that traditional IPO registration statement. So we're not doing that here. Here we have to only can sell it within the state to residents of that state. And the issuer has to have the 80% test, 80% of their business and assets within the state. Just because we're not registering with the SEC does not mean that we don't have to register our 147 intra-state offering with the state administrator. We most certainly do, right? And the way we're going to do that is qualifications. Now, after a resident of that particular state has held it for 6 months, they can sell it to someone else. All right, so let's talk about types of accounts that we have. So, types of customers. One thing we get tested on is what is a day trader? What meets the definition, right? If they've done 4 or more trades in a 5-day period, they're a day trader, and then their minimum becomes $25,000. There are irregular ways to settle trades. In terms of settlement, it's T+1. But sometimes we open up an account called DVP, delivery versus payment. This is typically an institutional customer. And here we have up to 35 calendar days to make delivery of that security to the commercial bank for payment. You should definitely be able to contrast joint tenants with rights or survivorship with tenants in common in terms of what happens to the decedent's share. In joint tenants with rights or survivorship, the decedent share goes to the surviving party. With tenants in common, the decedent share goes to their state or beneficiary. Very testable. To open the account, we need a picture ID, something that verifies that you are who you claim to be. We need a physical address. People don't live in PO boxes. We're more than happy to send things after we get the original documentation in place to a PO box. But on the original, we need to make sure we have that physical address, right? Who needs to approve that account? A principal approves that account. And then one of the questions on that new account form, are you or do you or your spouse work at a broker dealer, right? And if they say yes, then we make written notice to the employing firm and we follow any instructions they may have about, duplicate confirms and statements. In retirement plans, we should definitely know the retirement plans are cash accounts, meaning that the securities transactions need to be paid for in full, no margin. We should know that in retirement plans, if we take physical possession of those assets, we have to have them back in the appropriate spot within 60 days. So a rollover has to be accomplished in 60 days. It's important we can distinguish between retirement plans that are funded pre-tax, it's funded with money you've never paid taxes on, because that means everything coming out is taxed at ordinary income tax rates, as contrasted to a non-qualified plan that is being funded with after-tax money, and you do have a cost basis. Now, in terms of retirement plans, you get to your employer. There's two types. We should be able to distinguish between a defined benefit plan, where the employer assumes the investment risk, and a defined contribution plan. The one that most people are, familiar with is a 401k, right? Defined contribution, the employee assumes the risk. Oh, we should know that we have definitions. Definitions are pretty important. Sometimes I say, man, if somebody told me I had to take a test and I have to take it tomorrow, I'd probably go to the glossary and look at some definitions. We talked about the definitions of an accredited investor, the definition of a qualified institutional buyer of securities. Another definition we're held accountable for is the definition of a control person. All the stock a control person owns is called control stock. That's synonymous, I think, for test purposes with this concept of an insider, anyone who can influence the decisions of the corporation and their immediate family members, right? So this would be officers, directors, and principal stockholders. Remember, there are rules that apply to control persons as well as to control stock, the stock they own. Remember, they probably own some stock that they bought in the public marketplace. At one point was registered securities. They probably have some stock they got directly from the issuer. And regardless of how they got that stock, they're not allowed to sell short. They're not allowed to short swing profit. That's 6 months. And most importantly, this concept of 144 and whether they can sell the stock, right? They'll file the form no later than concurrently. And once that form is in place, over the 90-day period, they can sell up to 1% of the outstanding shares or the average last week's trading volume, whichever is greater. I think a good memory aided device is 144. 144. 1% of the outstanding stock, average of the last 4 weeks trading volume, whichever is greater, 4 times a year, every 90 days. So we need to be able to distinguish between limited power of attorneys and full power of attorneys. We should know that all powers of attorney, all trading authorizations cease upon the customer's death. With a limited power of attorney or limited trading authorization, I can make decisions about action, asset, or amount. The 3 A's. I don't need discretionary authority to make decisions about time and price. With full trading authorization, full power of attorney, not only can I make investment decisions, I can also withdraw monies in securities. And we have to have the documentation in place for discretionary authority prior to that first trade. So the principal has to approve that discretionary account prior to that first trade. In terms of suitability, we need to know about the customer. We have an obligation to the customer. I say, for me to do a really good job for you over time, I need to know a lot about you. The more I know about you, the better I'm going to be determining suitability. Yeah, they say, well, it's not your damn business. I said, well, actually it is, because my regulators required me to know my customers, KYC, know your customer. Now, it's important because I might want to determine as I do your personal balance sheet and we start our financial journey, whether you are accredited. I might want to know on your income statement that 200 or 300, right? So this would be important in terms of a data gathering. In terms of what happens once I open the account, right? I mean, I find the customer, I open the account, and then I do the trade. We do get tested on the flow of an order flow. A good memory aid device here is order peanuts, Mr. Carter, or other people's monies count. The first place it goes to is the order department, who transmits the order to the appropriate market center for execution. Order peanuts, Mr. Carter. Then it goes to the P&S department, purchase and sales. They generate the confirmations, which have to be in the mail by settlement. They match trades. And then it goes to the margin department, who determines whether monies or securities are due. And then the cashiering department actually takes receipt of monies and securities. So that's the order flow. If we have all those departments, well, then we're a clearing broker dealer. We can clear trade. If we don't have those departments, we're typically going to use somebody, if we're doing general securities, to do that for us, whether it's, clearing firm like Pershing or National Financial, whatever the case may be. In terms of customers who are 65 or older, all firms in our WSPs, our written supervisory procedures, should say, okay, what are we doing to protect seniors? And one other thing that a lot of firms are going to recommend to our senior customers, 65 or older, is that they appoint a trusted contact person. And this allows us as broker dealers to put a temporary hold on transactions while we reach out to that trusted contact person. By the way, the WSPs have all kinds of things in them, besides this thing about seniors, insider trainings found there, all kinds of things. All new hires have to read our WSPs, and then they sign that they've acknowledged them and they understood them. Right? It also tells us, like how we're going to close accounts, and I verify your identity, all that kind of stuff. The big ones for test purposes are in the WSPs, this exploitation of seniors, the insider trading, money laundering. Those are some big ones that would be found in the written supervisory procedures of the broker dealer. All right, so the biggest part of your exam is the third part, right? We said there's 4 functions to a broker. Can you find a customer? Right? Can you open the account? Function 2. Can you make an investment? 91 questions on investments, right? So this is target rich. And a lot of times when people struggle with suitability, it's because they're not well grounded in the investment vehicles themselves, right? So this is big. All right, let's talk about systematic risk and non-systematic risk, risks in the system. Non-systematic risk is also known as selection risk. The easiest way to avoid selection risk, test question, non-systematic risk, is to diversify. And the easiest way for most retail clients to diversify is in the context of a mutual fund. Now, in a mutual fund, you're still going to be exposed to systematic risk, risks in the system, the tendency of securities prices to move together. I think of it as when bad things happen to good stocks, right? And risk prevails there despite your diversification. Now, in terms of our expected return, the idea is we would expect to be paid for the volatility, the risk in the volatility we take. And the measurement of a stock or funds volatility as compared to the market as a whole is beta. So if I tell you it has a beta 1.5, that means it's 1.5 times volatile market, right? So if the market return is 10, it has a beta 1.5, our expected return would be 15%. So if I call you and I say, hey, good news, we got 18. We got more than the expected return. 13 would be nothing to chat up. That excess return over beta is called alpha. Right? This is part of, modern portfolio theory, right? Again, if you're going on to your 66, this is going to be a lot more testable there than it is on your Series 7. Okay, so there's kind of, when we're doing stuff, we're trying to make decisions about investments. One of the valuation techniques we're going to use is called fundamental analysis. To say you're a fundamentalist does not mean you're a member of the religious right. To say you're a fundamentalist means you're going to look at the financial statements. The financial statements would be the balance sheet, the income statement, and we're going to get that, be able to get that if it's a public company. We're going to get access to 3 10-Qs, quarterly reports, and 1 10-K, the fourth quarter, and the annualized results. That 10-K is audited. And what we're doing is looking there, doing some balance sheet calculations to hopefully find a margin of safety in terms of making the investment. So there are some balance sheet calculations you're held accountable for. Most of the time it shows up as recognition, but we may ask you to do it. And one thing we'd be concerned with when conducting fundamental analysis is liquidity. What is the company's liquidity? One thing we'd be interested in is working capital. Working capital is current assets minus current liabilities. Now, what best describes working capital? Our working capital can best be described as, another thing is the current ratio. That would be the current assets divided by the current liabilities. The acid test or quick ratio. We don't really want to have to sell off our inventory to pay our bills, right? So the quick assets would be the current assets less inventory. Again, we divide once again, and that gives us the quick or acid test ratio, a more stringent definition of liquidity in that particular corporation. Now, we're also interested in how is the business capitalized? How leveraged is it? Capitalization in a corporation consists of the equity, common and preferred stock, and the bonds. And we would be interested in perhaps knowing what percentage of that capitalization is bondholders, how leverage is it? So we might want to take the bond money, long-term debt, divide by total cap, shareholder equity, and that would give us that number. What is the gearing? Leverage is financial speed, and if the company is leveraged, it's going to make money faster and it's going to lose money faster. Now, I'm not going to ask you to calculate earnings per share, but remember, again, a valuation technique is a PE ratio, a multiple. If the PE is 12, you might have to do that exam. 48 divided by 4. I tell you the stock is 48. It has $4 in earnings per share. What is the PE? You say 12. Now, again, if you're a value investor, you'd be interested in a lower PE, 12 years to get back in earnings, what I paid for the price. If I'm a growth investor, I'm willing to pay a higher PE multiple on the business because I assume that, the earnings are going to grow. And so it just depends on what kind of an style of investor you are. Now, as a value investor or fundamentalist, I'm interested in margin of safety, as we said. And one thing I might want to try and do is buy the stock as close to the book value as possible. And book value is the theoretical liquidation value of the corporation, right? A, book value, B, par value, C, market value, right? Par value is the arbitrary number we set up the books with, 1,000 for bonds, 100 for preferred, $1 for common stock. And then remember, that's par. Market value is the supply-demand relationship in the marketplace. And then as I said, book value is that theoretical liquidation value of the corporation. All right, so we talked about that. It depends on your draw. I'm wishing for you tomorrow or today, depending on when you were listening to this, a dream draw. Everything you studied shows up. And I'm not going to go into balance sheets and exhibits and all that kind of stuff. But if you tell me you missed your mark because of balance sheets, I'm going to say, What else did you have? You had bigger problems elsewhere, right? You had bigger problems elsewhere. Now, we associate dividends with mature, stable businesses. So, as a value investor, I'd like to have a potential to make money from the income stream from the stock, dividends, as well as some price appreciation. Those two concepts together are called total return. And one component of my total return would be dividends. And I'd be interested in knowing what is the dividend payout policy of the company? How much of their earnings, if any, does the board declare or distribute as a dividend? Because remember, you don't have a right to a dividend, you just have a right to a dividend if declared, right? And so, for example, if the company in my previous example has $4 in earnings, pays out $2, that would be a 50% dividend payout ratio. We associate dividends with mature, stable businesses. I would be able to do current yield on a stock or a bond. And the way we do that is the AMP, the annual dividend or annual interest divided by the market price. So in my example, I told you the stock was 48. I told you paid a $2 dividend. 2 divided by 48, what it pays me by what it costs me, 4.2%. Now, tomorrow or today, whenever you're watching this, if you can't decide what to do in terms of math, divide. I would be doing you a great service to cover every key on your calculator except the divide key. If you're not dividing, you're typically doing the wrong math. So, for what it's worth. All right. So remember now, in terms of what we can invest in the capital structure of the corporation, where can we invest? We can invest in the common stock, the preferred stock, assuming they have preferred stock available. We can invest in their bonds, secured or unsecured. And in a corporation, we have a corporate charter. And in that corporate charter, we're going to stipulate the maximum number of shares the corporation can issue. That's the authorized shares. And then the corporations will issue some amount of those shares. Those are shares that have been placed with investors. Now, we wouldn't expect early in the company's life stage that they have excess capital and have retired shares or bought shares into the treasury. But that would be called treasury stock. So issued less treasury is outstanding. We should know that if the company buys stock into the treasury, the shares that are in the treasury stock, pay no dividends and have no voting rights. Right? And we said par value of a common stock is $1. Now, you do have rights and privileges as a common stockholder because you own the business. And one right you have is your preemptive right. Remember, your preemptive right is your first right of refusal on the new issuance of stock, right? You have a right to maintain proportion ownership. The mechanism for that is a rights offering. And you definitely want to be able to know that rights are short-term and at issuance exercisable below the current market price. What you've got to be able to do is contrast that with warrants, which are long-term and exercisable above, right? You're entitled to dividend if declared, your pro rata share. You're entitled to access to the corporate books, the 10Qs and the 10K. You have a right to vote on matters pertaining to the corporation. And depending on the corporate charter will depend on what kind of voting the company is using. We have statutory, we have cumulative, and we have super voting. Statutory is pretty straightforward. I have 500 shares. I have 500 votes. If we're voting on 3 board seats, 500 yes, no, 500 yes, no, 500 yes, no. If it's cumulative, 3 times 5, I have 1,500 votes. I can spend them in any fashion I'd like. If board seat A is important to me, I put all my votes there and I don't vote anywhere else. The cumulative voting protects minority shareholders because they have greater impact on any one thing. Super voting, a test question, is more than 1 vote per share. So these are the shares that Meta and Zuckerberg owns. Everybody else who owns Meta has 1 vote per share. He gets 10 votes per share because he has a different class of equity called super voting. The Ford family, right? Super voting is the shares that have more than 1 vote per share. We talked about you have a residual claim, right? Residual claim means we sell off all the assets, we pay off the liabilities, that book value thing, a concept. If there's money left over, you have it. Now, some companies might do a spinoff, right? So if a corporation does a spinoff, for example, they're talking about Alphabet splitting off YouTube or spinning off YouTube. So now YouTube would be an independent entity. And, the holding company Alphabet would say, Dean, for every 100 shares of Alphabet, here's, 20 shares of YouTube. Now, you are not taxed on the shares you receive from the spinoff until you sell, right? You only get taxes if, you tender shares for cash. So that would be a spinoff. And again, they would tell you what the issuer would tell you what your cost basis is. So again, I said, if it's not a spinoff, maybe it's you're tendering your shares to the corporation. You own Twitter, and you're accepting the cash tender from X Holdings. That's a 5420 cash offer. Once the person making the acquisition makes you that tender offer would have to be open for 20 days. Here, since it's cash, you're going to owe taxes on the 5420. Right? If it was, they're offering me shares, that Disney is acquiring Fox, I'm a Fox shareholder, and they offer me Disney shares, that would not be taxable. Very testable, though, the definition of a penny stock. A penny stock is a NASDAQ OTC stock under 5. Very testable. If you have a non-NASDAQ OTC stock under 5 in your portfolio, instead of getting a quarterly statement, you're getting a monthly statement. If you've been solicited for a penny stock as a customer, you're going to have to give a suitability statement saying you understand that you're buying a speculative low price security. That suitability statement doesn't apply if you're an established customer. An established customer would be somebody who's done 3 trades with us, or somebody who's had funds with a broker dealer for more than a year. I always get on debrief people who tell me that they got more test questions on preferred stock than they were expecting. I'm not sure what to make of that because I don't know what they were expecting. So anyways, here we should definitely know that par value is 100 unless otherwise stipulated. The reason that's important is, see, if you don't know par value is 100, you're going to be fumbling around with 5% would be $5 annually. You're going to be fumbling around that a conversion price of 20 would be 5 shares. So it's important to know that par value is 100. Now it's called preferred stock because you have preferential treatment in 2 areas. The corporation can't pay a dividend to common if it's in arrears to the preferred stockholders. So you have preferential treatment in dividends, and you have preferential treatment in liquidation. Now there's 2 types of preferred stock: straight non-cumulative, where it doesn't go into arrears, right? If they miss it this year, they just try better next year. Or cumulative, where it does go into arrears, right? And they have to take care of all the arrears, the current dividend, before they can pay dividend to common. We also have convertible preferred. Convertible preferred allows you to switch your status from being a preferred stockholder to becoming a common stockholder. And remember, whenever you get a conversion price, whether it's a convertible preferred stock or whether it's a convertible bond, you have to establish the conversion ratio. So the minute you get a conversion price, you got to go, bastards, man. I don't need that conversion price. I need that conversion ratio. So if they tell me to a day on my test or tomorrow on my test, the conversion price is 20, that's based on par, 100 divided by 20, my conversion ratio is 5 shares. What you're going to be asked to do, whether it's here or it's a convertible bond, is calculating parity. In other words, what would you be paying for the stock if you convert it? And the way we're going to do that is we're going to take the current market price of the convertible. We're going to divide by the conversion ratio, and that gives us parity of the common. That's what we would be paying for the common, equals what parity means if we decide to convert. And again, the economics may make that make sense. It may not, whatever the case may be. A preferred stock is a fixed income investment vehicle like a bond. And so preferred stock might have call risk. If it's callable and interest rates go down, the issuer may want to replace that high cost preferred with low cost preferred. As a preferred stockholder, you're hoping that you have call protection, that you have a call protection. That's time and price. How long before they can call it away from you? If I say my call protection is 3 years, that means they can't call for 3 years. And at what price can they call it? Right? That would be important. What price, Is it callable 102, 103, 104, whatever the case may be? You know, as we said, it's very testable to know priority. You know, I said that preferred stock has priority, preferential treatment, dividends, liquidation. So if we liquidate the business, the common stock is junior, preferred stock is senior to the common in liquidation, but the preferred stock is junior to the bondholders. Right? And you need to be able to do that from junior to senior, common, preferred, unsecured bonds, secured bonds, or senior to junior, secured bonds, unsecured bonds, preferred, common, right? I told you that a lot of times you have to contrast rights with warrants, and sometimes we'll add warrants to either the convert to as a sweetener to bonds. But the warrants would provide additional equity financing if they are exercised. And so we said you have to be able to contrast the rights and warrants. So, you know, in terms of equity capitalization, kind of hard to where you're going to put things. But remember this, when people exercise rights or warrants, they're providing additional equity financing to that corporation. All right, well, where do these stocks trade, right? The two major market centers on your exam are the New York Stock Exchange, which can best be characterized as an auction order driven market. And the other major market center is NASDAQ. And NASDAQ, remember, is the National Association of Securities Dealers automated quotation system. And that is a negotiated quote driven market, right? A little different. They're a little different in how they're organized. You're definitely going to get tested on American depository receipts. American depository receipts allow foreign securities to be traded in U.S. domestic markets. It facilitates U.S. investors owning those foreign securities. You know, the underlying business, if it's conducted in the foreign currency, very testable. ADRs have currency risk. All right, tax treatment of equity securities. So your tax treatment is based on how long you've been at risk. If you've been at risk for more than 12 months, you qualify for a long-term capital gain. And that long-term capital gain is typically going to be at a lower rate than your ordinary income tax rate. So it would behoove you to kind of think, okay, you know, I want my investment mind says so, my tax mind says, eh. Now I can use up to $3,000 in losses in my portfolio to offset my paycheck or earned income. So, you know, let's say I net all my gains and losses in my portfolio and I got a $12,000 loss. And let's say I made $90,000. I'm going to be able to adjust my income from 90 to 87, 90 minus 3. That means 9,000 is, you know, I'm going to have forward. Now, cash dividends are taxable, and there's two types of cash dividends, qualified and non-qualified. Both are taxable. Qualified is if I've owned the stock 60 to 90 days, who cares, prior to the record, right? And the point is it's just going to be taxed at a lower rate than a non-qualified dividend, which would be taxed just like at my ordinary income tax rates. And then remember, dividend of one corporation paid to another corporation is 50% tax excludable. You know, if I sell a security to take a loss, and I say, yeah, man, I really think that could come back, and I think I'll buy it back tomorrow. The IRS says, well, Dean, if you sell the security and take a loss and buy it back tomorrow, we don't really think you were through with it as an investment. They're right. So I would have to wait more than 30 days on the other side of 30 days to reestablish that. All right. So if we convert, that's not a taxable in until I actually sell, right? So when I switch my status from being a preferred stockholder to a common stockholder, a bond, I convert the bond and I convert, that's not a taxable event. It'll be based on when I actually sell. Remember, stock dividends and stock splits, same deal, not taxable. I just adjust my cost basis. I hope you remember me telling you this for tonight, today, or tomorrow, depending on when you're watching this. You always end up with more shares at a lower price. So before I jump in and try and do math, and I'm not, you know, I've got plenty of videos you can watch, do me do the math if you want to put it in the search bar. In this video, the Mighty 90, I'm just going to tell you that you can sometimes just shop the answer set. So I bought 100 shares at 50 and they pay me a 10% stock dividend. I go, okay, I need more shares at a lower price. I just shop my answer set, right? So you can do the math if you want. 10% times 100, 110, 5,000 divided by 110 is 45, 45. I think you'll find there'll only be one answer that has more shares at a lower price, right? Very testable about what happens when shares are inherited. So when somebody dies and somebody else receives those shares, there's a step up in the cost basis, right? Market value of death versus gifted securities. And gifted securities, the recipient assumes the cost base of the donor, right? So, when you sell your shares, let's say you've been buying shares of the same company over several time frames. So I've been buying, Exxon for the last 30 years, and I decide I want to sell Exxon. I have different cost valuation techniques. I can say the first shares in Exxon are the first shares I'm selling. I typically don't want to do that because that's going to be the ones I have the lower cost basis and will generate the biggest tax. I could do LIFO, last Exxon shares I bought are the first Exxon shares I'm selling, typically a higher cost basis. The best would be share identification, where I actually identify the shares in Exxon on which I have the highest cost basis as the shares I'm selling. Generates the lowest tax. I can do it any way I want. Remember, test question though, the IRS will impose FIFO if I don't have the proper record retention and documentation. All right, well, most people get where they're going without crashing and burning in mutual funds, right? So I joke, when you pass your Series 7, you go back to your manager, you say, man, I know I have a Series 7, but it is okay if I just sell mutual funds. He's going to say, that would be wonderful. So, there are some things that people don't like about the tried and true traditional plain vanilla mutual fund. A lot of people don't like this idea that we're always doing business based on the next calculation of the NAV, forward pricing. A lot of people don't like the idea that you can't buy an open-end mutual fund on margin. And so ETFs, test question, exchange traded funds. Trade in the secondary market. I got to be able to contrast a ETF with a traditional plain vanilla, open-end fund. ETFs can be bought on margin. They're marginable, eligible for purchase on margin. For test purposes, ETFs are passive. And that means they have a lower cost structure and more tax efficient. Right? UITs, unit investment trusts. Unit investment trusts are professionally selected. The assets in the portfolio are professionally selected, but the portfolio is fixed. It has passive management, and what follows from that again is this idea of a lower cost structure. Passive management, because you're not paying a manager buy and sell things. We say, what would you like to do with your idle monies at our broker dealer? Would you like to put it in a traditional checking account, demand deposit? Or would you like to put it in a money market fund, a money market mutual fund? You should definitely know that money market mutual funds would be appropriate for somebody who has a short time horizon. Like, hey, Dean, I sold my home in California. What should I do with the money? I'm moving to Texas and I'm going to be buying a home there soon. I say, well, why don't we put it in a money market, right? The NAV is $1, and then you should definitely know what are money market instruments. Money market instruments are high quality debt maturing in less than 12 months. So what would be found in this money market fund? Commercial paper, large unsecured borrowing by corporations, max maturity 270 days, issued at a discount, bankers' acceptances used to facilitate foreign trade, issued at a discount, max maturity 270 days, T-bills, no better credit quality than the US T-bill, and then negotiable jumbo CDs, right? All those would be found in there. Now, in an open-end mutual fund, we're continually offering new shares to the public. And so that means we have to give them a prospectus, right? We're going to have to comply with 33. With a closed-end fund, we do a one-time initial public offering, and then those shares are going to be trading in the secondary market. It's very testable to be able to contrast open-end and closed-end funds. Now, in the Investment Company Act of 1940, we have to calculate the NAV at least once per business day. We're always doing business based on that next calculation of the NAV. The maximum sales charge in an open-end mutual fund is 8.5%. So, the formula that we do business based on is the NAV plus the sales charge. So if a mutual fund has an NAV of $9.15, a sales charge of 85 cents, the public offering price would be 10. The largest single expense to the fund is the investment advisor. Be careful, RTFQ today or tomorrow. If I ask what's the largest single expense to the client, it's the load, 8.5% in my example I just had. Different than what's the largest single expense to the fund. Some funds have a promotional expense. Promotional expense for advertising, marketing, sales literature, key point, promotional expense, not an expense for managing the money. And if you want to refer to yourself as a no-load fund, can you still have a promotional expense? The answer is yes, but that promotional expense can't be more than 1/4 of 1%. If it's 1/4 of 1%, you can still hold yourself out to the public and refer to yourself as a no-load fund. And if you go past that, then you can't refer to yourself or hold yourself out as no load. But in any case, over the life, you can't go past 3/4 of 1%. Now we have A shares, B shares, and C shares. A shares are typically the ones you're going to get tested on. And A shares typically have a quantity discount. So they would be appropriate for somebody who has a long-term time horizon and may be able to qualify for the breakpoint. A breakpoint is a wonderful thing. It's a quantity discount. That's good. Again, be careful. A breakpoint sale is bad, right? Breakpoint is good. Breakpoint sale is bad. A breakpoint sale is when you try and avoid the quantity discount, the breakpoint to maximize your commission. So the easiest way to stay out of trouble here is to tell the client all the ways he can qualify for the reduced sales charge. And I say, listen, I understand you have $80,000, not 100. The breakpoint's at 100. Why don't we fill out a letter of intent? If you will tell the mutual fund family, the fund distributor or sponsor, that you intend to come up with the additional 20 grand within the next 13 months. LOI is good for 13 months. They'll give you the reduced sales charge. Woohoo! Right? You say, Dean, there's no chance I'm going to do it. Oh, whatever. You call me and said, damn, I should have done it. I just came into some money. The LOI can be backdated 90 days. That 90 days is inclusive of that 13 months. You say, hey, Dean, my investment club, we want to, get a break point. I say, nope, no quantity discounts, no break points for investment clubs. As I said, this is an investment vehicle where more people get where they're going financially without crashing and burning than any other kind of investment vehicle. And one thing we can add to this is dollar cost averaging. What makes dollar cost averaging work? Fixed dollars invested regularly. What is the end result? You're going to have a lower average cost of the underlying shares, doesn't guarantee a profit, right? So mutual funds tax consequences of mutual funds. The IRS has been kind enough to say that as long as a mutual fund or a REIT, REITs are very similar. Mutual funds provide professional management, diversification, ease of ownership, professional management of a portfolio of securities. REITs are very similar. Professional management, diversification, ease of ownership, but it's a portfolio of real estate investments. Both of them must pass through at least 90% of their net investment income. A good memory aid device for this is DI-90. DI-90. That stands for dividends on the stocks in the portfolio, plus interest on the bonds in the portfolio, plus expenses. They have to pass through at least 90%. Now, a lot of mutual funds have what are called DRIPs. You may hear the term DRIP today or tomorrow, depending on when you're watching this. And DRIP stands for Dividend Reinvestment Program. And so I tell the mutual fund that I don't need the dividends or the capital gains, just to go ahead and reinvest those in the fund. Well, the IRS says, as far as they're concerned, I could have got the money, and that's the same as getting it. Constructive receipt. So I'm going to owe taxes on the reinvestments of the dividends and capital gains distributions. I'm going to get 1099 and I'm going to owe taxes on that. Variable life. I don't know if it's helpful, so don't leave my channel and tell your compliance officer what Dean said on his YouTube channel. We're just trying to pass the test. Anyways, I think of a variable annuity as a mutual fund with an insurance wrapper. A mutual fund with an insurance wrapper. Right? So in a variable annuity, we refer this as a non-qualified retirement plan. For test purposes, what that means is we're using after-tax money. We're not getting this through an employer. So, you have a large amount to invest. You've taken care of all of your other retirement plans. You've maxed out everything available work. You've maxed out, IRAs, all that other stuff. You still want to add some more money for retirement. You say, Dina, how about I give you $100,000 for this variable annuity? That $100,000 is money you've already paid taxes on. That money is going into a separate account, a mutual fund. And so you, the annuitant, are assuming the investment risk in a variable annuity. Now, in that variable annuity, what you're buying is accumulation units, which are the same as shares intellectually. You say, I have 6,000 accumulation units is the same thing as I have 6,000 shares. And when it's over 59 and a half, right? Like all retirement plans, I would know the 59 and a half. Then you can decide what you would like to do. Would you like to turn this into an income stream that you can't outlive? That'd be kind of cool. And what we're going to do is turn your accumulation units, if that's what you want to do, into annuity units. Maybe you want to do a random distribution. And so let's say now there's $1 million in there. You say, Dina, send me $100,000 of my $1 million. I say, okay. You say, Dean, do I owe taxes on that? I say, you most certainly do. You say, well, then send me the 100 I put in there. No. I say it's LIFO. Last money's in are first money's out. So if you're doing a random distribution, you're not going to get back to your 100 till you get, 900 out of it. All retirement plans are taxed at ordinary income tax rate. There's no way in a retirement plan of any kind to turn it into anything other than ordinary income. So he said, well, geez, Steve, you should have told me that. I go, absolutely. That's important, right? Because if you were in like an index fund, you held it for more than 12 months, you'd qualify for that. Now, let's say you say, Dean, I'd like to annuitize. I'd like to turn it into an income stream. I say, okay, so we're going to turn your accumulation units into annuity units. And the largest monthly check will be test question if you choose life only. If you tell the insurance company you just want to be paid for your life and your life only, that'll give you the largest check. Now, that check is going to go up and down based on the assumed interest rate, the EAR. Whatever the EAR is, we do better, check goes up. We do worse, it goes down. We get the EAR, it remains the same. We're going to bump you all over the place because, you're in retirement. Another investment vehicle we have is partnerships. Oh man, too late now because these Mighty 90 videos are for the night before or morning of your actual investment. So too late now. But people overdose on partnerships, test prep vendors, right? I would expect today or tomorrow you're going to get a couple questions on partnerships. You tell me, Mr. Mark, because of partnerships, right? Participation program. And I say, What is very, very testable, and angels weep for you. In fact, if you miss this today or tomorrow, depending on when you're watching this, I would flunk you immediately on the entire exam. Your seat should just shoot you into the ceiling and say, hey, if you can't get this, partnerships are not liquid. You do not have a freely transferable interest. You can't be admitted or emitted without the permission of the general partner. Emit means leave. Right now, partnerships, direct participation programs, have a flow through of the tax consequences. So as an investor in a partnership, you're going to get a K1, who cares, that shows your pass through of income or losses. Now, remember, we said in your portfolio, you can take $3,000 against your income, your paycheck. Not so with partnerships. What happens in a partnership, it has to stay over there in that area, right? So you can't use passive losses to offset anything other than passive income in that part of your portfolio, right? flow through. I would have a couple questions, be ready for a couple of questions on types of direct participation programs, partnerships. I would be prepared to know that an oil and gas exploratory or wildcat program is the riskiest type of partnership we have. I would know that we have partnerships that have tax credits. If we organize a direct participation program that's going to do low income housing or historic real estate, there would be some tax incentive. Direct participation programs, private partnerships are either sold as public investments or as private placements, right? So if it's a private placement, that means you have to be credited. If it's a public program, well, anybody can get in there. Options. So in terms of investments, the three biggest categories are mutual funds, munis, and options. Right. So this video, the Mighty 90, I'm going to fly high here because we're not trying to re-lecture the 150 videos I have on options. But boy, make sure you get all the aim and shoot, point and click questions you're entitled to. So you should definitely know that the Options Clearing Corporation is the issuer and guarantor of all option contracts. You should be able to distinguish American style as contracts that can be exercised anytime, which is typical of equity option contracts, and European styles where you can only exercise at the end, at expiration, right? In all option contracts and resulting stock trades is T+1. Now, when you want to establish a position, you're either going to be doing an opening purchase to go long. Opening purchases are used to establish or add to long positions. Opening sales are used to establish or add to a short position. So there's three things that can happen to the option contract. And so most questions, if they're going to give you a question like this, are going to end with one of these three events. The option contract got traded, the option contract got exercised, the option contract expired. T. It's a good way to remember that, T. If you're trading the contract, you're going to be doing an offsetting transaction, a closing transaction. You're liquidating that option position. And the way you eliminate or reduce or offset a long position is with what we call a closing sale. Now, this will be A, B, C, D on the exam. And the way you eliminate, offset, or reduce a short position is a closing purchase. So you're trading the option. The option contract can be traded, it can be exercised, or it can expire. There's two components to the premium on an option. There's intrinsic value and time value. And for you today or tomorrow, intrinsic value is more important because they like to sometimes say you close out at intrinsic value. If you don't know what intrinsic value is, you might kind of get stuck trying to close something out. So remember, intrinsic value is synonymous with saying in the money. In call contracts, what we're asking about is the relationship of the market price to the strike price. And so call up. If the market price is up from the strike price in an option contract, has intrinsic value. Now be careful, that's good news or bad news is a different question. Put contracts, put down. If the market price is down from the strike price, has intrinsic value. Time value erodes. Options are wasting asset at expiration. The option contract is only going to be worth its intrinsic value. If it has intrinsic value, it's going to get exercised. If it has no intrinsic value, it's going to expire worthless. So, I'm kind of saying I don't have to tell you what happened. You might have to figure it out, right? To the contract. Position limits apply to the same side of the market. Option contracts are derivatives. And we don't want the tails wagging the dogs, right? The position limits apply to what we call the same side of the market. And they apply to what's called a class. A class is the type plus a stock. Apple calls is a class. Apple puts is a class. And the bullish or buy side of the options market is going to be long calls and short puts. So, I say assuming position limits are, right? Now, if they actually give you, don't remember, if you don't know position limits, it's not a problem. If you get this tomorrow, it's simply going to be what is the buy side or sell side. recognition. If they ask you to do anything with position limits, I doubt they will, but if they do, it would apply to the same, the classes I just said. One other point though, whether it's this or anything other, just be careful for a phraseology where they say a husband and wife acting in concert. And so when they say acting in concert, that means you're supposed to consider whoever this is in the question as one party for purposes of the rule, right? By the way, and we always assume husbands and wives are acting in concert, so I don't even have to tell you that. Right? If a husband owns 4%, his wife owns 8%, they own 12% of the company, they're control persons, right? So that kind of thing. The sell side or bear side. Now we remember we're talking about the stock, right? A long call buy side, choice to buy the stock, short put, obligation to buy stock. Sell side, we're talking about the stock. Long put, choice to sell the stock, short call, obligation to sell the stock. Leaps, long-term equity appreciation potential securities. Technically, a leap goes out 39 months, but in practice, 30 months. And the leap is the only option contract if you're long. If the short leap doesn't matter how long you've been short. The only option contract that may qualify for long-term capital gain would be a leap contract that you've been at risk for more than 12 months. And, another way I could test you on that is to know that longer-term option contracts always have greater premiums. I could say, which one of these is most likely a leap, give you the same strikes, and you go, wow, look at the premium on that thing, right? Kind of late in your study effort here, right? So if you're watching this video the night before or morning of, the most important thing is to be confident in the execution of your study plan, because that's come to an end. Be confident in yourself, and most importantly, be confident in your answers today or tomorrow. That being said, mantra for option premiums is lower, higher, longer. Lower, higher, longer. Lower strike call contracts always have greater premiums. Higher strike put contracts always have greater premiums, and then the one I just talking about now. Longer term option contracts always have greater premiums. That leap is going to have a huge time value to it and a bigger, much bigger premium. We have non-equity options. I would be prepared to answer a question about a yield-based option contract, which has a direct relationship with interest rates, right? And then I would be prepared to answer a question about VIX, right? The VIX has got a direct relationship in terms of what you're trying to do, right? The VIX is the fear gauge, right? So, people are willing to pay more for puts. So if the market is going down, the VIX call would go up. So, low probability, but it could be there. We definitely should know in terms of suitability, when we're doing covered calls, covered means I own the stock, that we're doing that to generate additional income. You do get tested on advanced option strategies. And if you can't identify the strategy, you're in trouble, right? So how do we identify spreads? Spreads are difference, right? Soda, same option, different action. Same option, two types of option contracts, calls and puts. Same option, call, put. Different action, buy, sell. Straddles, same action, buy, different option. Straddles with different strike prices are called combinations. In the spread category, you're either buying the spread, debit spread, or you're selling the spread, credit spread. You got more money out than in, or you got more money in than out. If it's a debit spread, we already know the max loss, right? Because whenever you buy an option position, buy a call, buy a put, buy a straddle, buy a spread, the max loss is what you paid. Right? And if it's a debit spread, we know exercise and widen would be profitable. Debit call spreads are going to be bullish, and debit put spreads are going to be bearish, right? Because that's what you're doing. In a debit call spread, you're selling the higher strike call to pay for the lower, but the lower strike is going to be dominant. Same thing in a put spread. You're buying the higher strike put, selling the lower put to, help you pay for it, but you're bearish. Now, if it's a credit spread, we know credit, expire, narrow. No circumstance where you're not going to be correct. Credit has 6 letters, expire has 6 letters, narrow has 6 letters. And whenever we sell a spread, credit spread, more money in and out, sell a call, sell a put, sell a straddle. We should know that our max gain is what we've collected. Now, credit call spreads are bearish. I think a credit call spread is a smart bear. That's where I'm selling the lower strike call, but I'm buying that higher just to put in that ceiling so it doesn't blow up on me. And credit put spreads are bullish. Again, I would want this stock to be above the higher strike so I can keep the money go neener, neener, neener. But I will buy that lower strike just in case, just in case. Straddles, we have two versions of straddles, long and short. Same action, buy, or sell, different option. So we need to be able to identify a straddle. We need to be able to calculate the break evens. We need to determine where it's profitable. We have a gray memory aid silo. If it's a short straddle or combination, we want the market price to be within those two break evens, my upside break even and my downside break even. If I'm long a straddle or long a combination, I would want the market price to be either above or below those break evens. Very testable to know that a naked uncovered call, right, would expose a customer to unlimited risk, right? So, an uncovered put, it's to final, might be a lot of money, but I know the worst case is you're going to pay the strike price for worthless stock. So you definitely should know that naked calls, short straddles, expose customers on unlimited risk. Now you have, remember, 4 basic option positions. And on all those option positions, you need to know break even. There's only 2 break evens, call up and put down. So for long or short calls, strike price plus premium. What's the distinction where you want it from that? For put, strike price less premium. And again, what the distinction is, where do you want it, right? Now, when you have more than one thing going on, a covered call, a spread, a protective put, what you're going to do is you're going to net the 2 numbers for break even, right? So a covered call, I'm paying for the stock, buy, sell, I'm selling the option. The break even is the net of the numbers. Stock cost less premium. Protective put, I'm buying a put to protect the stock position. Buy, right? So I'm going to combine those numbers and that will be my break even, stock cost plus, right? So, in terms of break evens. Spreads, we have some memory aid devices that can be helpful for break evens. The break evens, as we said, for the basic options are call up, put down. We said for covered calls, stock cost less premium. For a protected put, it's what you paid for the stock, what plus you paid for the insurance. Straddles, it's going to be strike price plus total premiums, buy, or sell, when we combine. Strike price minus total premiums. That's the only one where we're going to have 2 break evens. Now in spread, a good memory aid device for that is CAL or push. CAL stands for call, add to the lower. Call, add to lower. Push stands for put, subtract from the higher. So test taking trick, we know that in a spread, the break even has got to be somewhere between the 2 strikes because that's where all the action takes place. So I can get a 50-50 today or tomorrow by just looking at the answer set and say, okay, it's got to be something within those 2 strikes because that's the whole point of that transaction. So in a call spread, doesn't matter debit or credit, I'm going to take that net premium added to the lower strike. In a put, doesn't matter whether it's debit or credit put spread, I'm going to subtract it from the put. Tax treatment of options, people overdose. Be careful. Today or tomorrow, usually a tax question is a camouflage profit or loss question, right? All option trading is short term. So the exception is you buy a leap and you hold it for more than 12 months. But other than that, it's all short term. Now, cost base typically follows break even. So on your test, if they ask you cost basis and you do break even, 98 out of 100 times you're going to be correct. Right, so if I buy an Apple call, Apple's at 200 as I'm making this video, and let's say I buy an Apple call at 9. I exercise. My break even's 209. My cost basis is 209. So for the most part, the cost basis follows the break even. Expire. Well, if it expires, it's either a short-term gain or loss, depending where they bought the contract or I sold the contract. In the old days, in the old days. A lot of people would refer to the Series 7 as a stockbroker's exam. And I always thought if there were truth in labeling, it should be called the bond broker's exam, because there's way more questions about bonds than there are about stocks. You're held accountable for 3 issuers of debt securities: corporate issuers of debt securities, municipal issuers of debt securities, and the US government as an issuer of debt securities. Right now, we talked about foreign currency risk, and we said you have foreign currency risks and ADRs. Another area in which you have foreign currency risk would be a euro bond. There are 2 types of bonds: euro dollar bonds that are denominated in US dollars. And again, the test is pretty egocentric. If I'm getting paid in dollars, I don't have currency risk. And a euro bond, keyword missing, dollar. This is where the issuer has agreed to pay not dollars, but euros or Swiss francs or British pounds or whatever the case may be. And I'm going to have to turn those euros or Swiss francs or British pounds into dollars. So euro dollar, no currency risk. Euro bond, I do have currency risk, right? Another risk I have in bonds, the 2 basic risks I have in all bonds is interest rate risk and default risk, right? But there's other ones as well, right? We have call risk associated with the declining interest rate environment. We talked about that as it relates to preferred stocks. And we said call protection consists of 2 things. You don't have call risk in zero coupon bonds because zero coupon bonds are not callable. And you don't have call risk in treasury bonds because treasury bonds are not callable. On the test, you have to be able to contrast debt security, ETN, debt security. That's the test question. An exchange traded note is a debt instrument, and you are a creditor, right? And to the sponsor, right? The holder, they owe you this money and they may or may not pay you, right? So ETN is a debt instrument, very testable. So ETFs are equity investments. ETN's test question is a debt instrument with the risk associated with a debt instrument. Non-US market securities. So a sovereign debt, the default risk, you have 2 risks in the sovereign debt: default and currency risk, right? Think here, I buy some Turkish bonds, sovereign debt of Turkey or sovereign debt of Argentina. So I have 2 risks: the risk they default, but also turning the Turkish lira back into dollars, right? Yields. You should definitely know the nominal yield does not change. That nominal yield is also known as the coupon rate or the fixed or stated rate of return. We said you should definitely be able to calculate current yield. And you are going to get asked not to calculate yield to maturity or yield to call, but to understand that relationship. The most testable version of this is going to be yield to call on the bond at a premium, right? So the bond at a premium is very likely to be called because interest rates have gone down. Very testable, know that inverse relationship of interest rates and bond prices. And hopefully, you've got your teeter-totter and your seesaw and you're ready to kind of roll on this thing about the relationship, right? We should definitely know that bonds pay semi-annually. We said there's 2 risks: interest rate risk and credit risk. We should be able to count current yield. Credit risk, we should know, is based on the risk that you don't get paid. And we have firms that give credit ratings. And the one they like on the test is Standard & Poor's. And you should be prepared to tell me that a triple B, an issuer with triple B bonds, those triple B bonds are investment grade. Less than triple B, those bonds are less than investment grade. If you buy a bond at a discount, a zero coupon bond, OID, you have to do straight line amortization upward called accretion each year. And it kind of sucks because there's an imputed interest you're receiving. And remember, you owe taxes on that. So you're paying taxes on money you're not actually receiving. So wouldn't be a good recommendation for somebody in a very high tax bracket. Might be a good recommendation for somebody who needs to set some money at some future date, wants to lock in a rate of return, something like that. On the corporate bonds, we should know secured bonds versus unsecured bonds, right? In the corporate setting, we have secured bonds, mortgage bonds secured by real property, equipment trust certificates secured by major movable equipment. We have collateral trust bonds secured by marketable securities placed in escrow. We have unsecured bonds, debentures. The only thing that backs the debenture is the full faith and credit of the issuer, right? We have zero coupon bonds. We talked about that. It's 3 issuers of those IEDs are zero coupon bonds. But we said they might be good for somebody who has a target investment, like in college or something like that. They're very, very volatile with interest rates, right? Because, in a regular bond, if there's an income stream, somebody would buy it to capture the current yield, and that's not true of a zero. Long and low. Longer term bonds are always more volatile than shorter term bonds, long and low. And bonds with low coupons or no coupons are going to be more volatile with changes in interest rates. Convertible bonds, you're going to have to calculate parity maybe once, maybe twice. And remember, we said when given the conversion price, you got to say, bastards, I need the conversion ratio based on par. So if I tell you in your test, the conversion price is 40, you take 1,000, get 25 shares, right? And then parity is typically going to be the current market price of the convertible, right? So if I tell you now the bond's trading at 1,300, and we figured out it's 25 shares, I say, hey, if we buy this convertible bond for 1,300 and we divide by 25, we bring 52 for the stock. That's called parity. Parity means equal. Parity of the bond would be going the other way, take the number of shares times the current market price. We have income or adjustment bonds that trade flat. Trade flat means no calculation of accrued interest, that the buyer does not owe the seller the dollar amount of the accrued interest. That would be true for income or adjustment bonds. That would be true of bonds in default. And that would be true of zero coupon bonds. Income or adjustment bonds are used in bankruptcy and restructurings. They only pay interest when and if earned. So it's kind of counterintuitive. The one thing you don't want to give somebody who wants income is an income bond, right? So municipal securities. So, you're basically going to get tormented with the 2 types of muni bonds, GOs and revenues, right? GOs and revenues. We want in a municipal security to have a legal opinion done by a bond counsel. And the better version of this would be unqualified, without reservations. The legal opinion, the bond counsel is going to opine that they have the legislative authority to borrow the money, that the bonds pay interest that is federally tax exempt, and that the bonds are exempt from the Prospectus Act of 33, no prospectus. When selling brand new munis, we don't use prospectuses. We have a prospectus-like document called an official statement. Now, over the many years, some muni bonds have lost their legal opinion, and we say they're trading X. X legal. X is Latin for without. When you have an X spouse, that means you're long term with your spouse attached. So if I tell you this muni bond is trading X legal, that means it's without a legal opinion. We have serial maturity. Those are bonds that come due at different dates. And if the bond is coming due at different dates, we're going to quote that on a yield to maturity basis. The fancy word for yield to maturity is basis. So to say that a bond has a basis of or yield to maturity of, those are synonymous terms. Term bonds, all the bonds come due at the same time. And all bonds trade over the counter in a negotiated quote-driven market. And my minimum spread trading corporates and munis is going to be an 1/8. If you get stuck on what an 1/8 is, you can take 1 divide by 8 on your calculator to times 10 a bond point. And what you're going to have to do is turn that into a dollar price, right? So I work with a bond desk. I say, I'll buy it into my inventory 98 1/8. I'll sell it out of my inventory at 98 3/8. That's my spread. Now, when it comes to govies, my minimum spread is going to be at 32nd. And we set all these bond pays semi-annually. So it's either J&J or J&J 15. That would be January and July, or January and July 15th, or F&A 15, whatever the case may be. Now, remember, the buyer, if you buy it, I say, listen, let's just say today, I'm making this video April, let's say it's April 22nd, I think. And so if I sell the bond to you, I say, listen, on July 1st, we'll assume it's J&J. I say, listen, these were my bonds for January, February, March, and most of April. So not all that money you're getting on July 1st belongs to you. Some of that belongs to me. And you say, well, Dean, when I get the check, I'll send you your pro rata share. I go, no. The Uniform Practice Code, which standardizes trading within the securities industry, says you, the buyer, are going to pay me, the seller of the bond, the dollar amount of the accrued interest calculated from last time the bond paid interest up to, but not including, settlement. It makes sense. It'll settle tomorrow and then the year bonds, right? So then that interest is yours going forward, right? Now, when we're underwriting bonds, muni bonds don't fly off the shelf, right? So syndicate could be open for quite a while. And so the dated date is the date the bonds start to accrue interest, right? And if you buy my bonds, I thank you very much from the syndicate. And, we're going to settle up with you at some point. You're going to owe that dollar amount accrued interest to the syndicate. So day to day just means start to accrue interest in that underwriting period. All right, so GOs, analysis of GOs, things that go with GOs. They love all the following GOs except or revenues except. And so when we're talking about GOs, we should know some of the terms that go with GO bonds, like overlapping debt. Overlapping debt is a concept of coterminous, meaning there are two more taxing agencies sharing some of the same geographic boundaries, able to issue debt separately. We should know that property taxes are to support local government. I joke taxes are the price you pay for civilization. The more civilization you want, the more you're going to have to pay. Right? States don't have property taxes, so there's no overlapping debt. Right? So, Las Vegas is 100% coterminous with Clark County, Nevada. Can't be in Las Vegas without being in Clark County. You can be in Clark County and not be in Las Vegas. So here's the point. I'm paying some taxes, property taxes for Las Vegas. I'm paying some taxes that go to the county. I'm paying for the Clark County Unified School District. That's overlapping debt. The state of Nevada does not have property taxes, so there would be no concept there of overlapping debt. The taxing authority, right? So to issue a GO bond, you have to have taxing authority. Now, in revenue bonds, we'd be interested in competitive facilities, right? We want to have a feasibility study where the feasibility consultant addresses that. We want to make sure that the promises are in written form. So we have what's called a trust indenture. That's the written covenants or promises between the issuer and the trustee for the benefit of the bondholders. One of the things that we want to be addressed in the trust indenture is the flow of funds. And you should always assume on your test today or tomorrow, net revenue pledge. You should tell me that the operations and maintenance fund has priority. I'm not going to make you crunch debt service coverage ratio tomorrow, but you should know that goes with a muni. Some munis have credit enhancement, have insurance. And so, Detroit was a major default. And you call me and you say, hey, Dean, the bonds I own in Detroit, were they insured? I said, well, let me check the CUSIP. Every security has its own unique identifying number known as a CUSIP. Right? And I say, oh, good news, your bonds are insured. They're going to continue to pay you the timely payment of interest and principal. Woo-hoo! We also have municipal short-term debt instruments like TANs, BANs, and RANs, tax anticipation notes, bond anticipation notes, revenue anticipation notes. These are kind of like the muni equivalent of borrowing against receivables. All right, so we have special tax bonds where the special tax pays the interest and principal. We have moral obligation where the state may or may not use legislative apportionment to pay back the bonds. We have double barrel bonds where we have two promises or pledges, a user fee, but if the user fee is insufficient, the state, the municipality will use its full faith and credit to pay. It's a type of GO is the point. Be careful. There is some muni bonds that are subject to the alternative minimum tax. Very tested. The bonds that are subject to the alternative minimum tax are industrial development revenue bonds or industrial development agency bonds, ADR, IDRs, or IDAs. Very testable know those bonds are subject to the AMT. Also very testable know that corporate credit backs the bonds. There's no stickiness to the city. There's no stickiness to the city. Corporate credit backs that bond. Well, the MSRB in its infinite wisdom has said, the MSRB, by the way, remember, Municipal Securities Rulemaking Board, publishes rules, A rules, D rules, G rules. They don't have any enforcement power. So who enforces the MSRB rules? If you're a bank, it's a FDIC, Federal Reserve Board, Comptroller of Currency. If you're a broker dealer, SEC, FINRA. But anyways, they have said that a 529 plan is a municipal security. Okay, if they say it's a municipal security, aye. And if you get a question about an ABLE account, the ABLE account would be the onset of the disability is age 26, before age 26. We said that all of the bonds, we said the accrued interest is paid by the buyer to the seller. And we didn't want our high talent men and women to have to remember nursery rhymes and knuckle humps about how many days have September. So corporate communities every month has 30 days, and that means the calendar has 360 days in it, right? We're going to get asked whether somebody should buy a corporate bond that's taxable or a muni bond that's tax-free. So we should be prepared to take the taxable yield and times it by 100% minus the tax bracket to figure tax-free equivalent, or take the muni bond yield, tax-free yield, divide by 100% minus the tax bracket. The only component of muni bonds that is tax-free is the coupon. The capital gains are always going to be taxable. We have alternative investments. So we have private equity funds, we have venture capital funds, we have hedge funds. Those are organized as private partnerships sold under Reg D, and they're allowed to do, as a hedge fund, for example, all kinds of crazy things. But those, the model for payment freeze for all of those, and I would know this, is 2 and 20. So typically, if you're in a private equity fund, a venture capital fund, or a hedge fund, the general partner is going to want 2% of the assets under management and 20% of the profits. Yeah, we have CMOs, collateralized mortgage obligations. These are cash flows that cascading cash flows carved out of a pool of mortgages, right? The French word for that is a tranche. We should know that plan amortization classes, PACs, are the early cash flows and they have more predictability and therefore less risk. Whereas tax targeted amortization classes are those back end cash flows, less predictability, more risk. We have treasury securities, very lightly tested, but we should know that T-bills have no credit risk, no interest rate risk. T-notes are 2 to 10 years, bonds are more than 10, right? And again, you still have interest rate risk. We have treasury receipts and treasury strips. Treasury receipts are created, zero coupons created by broker dealers, and strips come directly from the US Treasury. That's the government version of a zero coupon bond. We have TIPS, Treasury inflation protected securities, where the government adjusts the principal they owe you every 6 months, the principal, not the coupon. The coupon doesn't get changed. The only thing that gets changed semi-annually is the principal based on the consumer price index, right? We have agency securities. You're definitely going to get tested on Ginnie Mae. Ginnie Mae, unlike the other agencies, government agencies, has the full faith and credit of the US Treasury. Unlike the others, it pays interest and principal monthly. The only investment vehicle on your exam that pays interest and principal monthly is a Ginnie Mae, and Ginnie Mae's test question are fully taxable. Fully taxable. Disclosures, we have to disclose control relationships. You know, for example, a broker-dealer Merrill Lynch is controlled by a parent company, Bank of America. That control relationship always would need to be disclosed, and we can't use discretionary authority when there's a control relationship. When there's a control relationship. Some broker-dealers pay investment advisors compensation with what are called soft dollars. You know, we love investment advisors because they do a lot of business with us through the broker-dealer. And the question about soft dollars is we can't use soft dollars to pay travel, rent, or furniture. You know, when you open your account, it's very important to make sure we've got everything correct. So within 30 days of opening an account, I'm going to say, hey, listen, we're going to send you a copy. Could you please look that over and just make sure I've crossed every T, I've dotted every I, just to make sure that's, you know, okay. Now, if there's any changes that are made to that document, we'll also send you a copy. And we know that your financial situation could change dramatically over 36 months. So we'll also send it to you every 36 months just to make sure everything's still current. Or if it needs to be updated, you can let us know. If you leave us, very testable, you transfer your account. So, I'm your broker. I receive a transfer instruction form, a TIF, through what's called ACATS. I have 1 business day to validate the positions, and I have 3 days to accomplish transfer. Types of orders. I think a lot of test takers get hung up on the types of orders. There's 2. There's market orders and there's limit orders. Market orders, immediate execution, best available price. Limit orders, my price or better, right? If I'm trading over the counter, there's going to be a market maker who's going to give me a quote. If I'm a market maker, maybe you work at an order entry firm and you call me, you say, Dean, what's your quote? I said, my quote is 1510, 1520, 5x8. Right? And if you have a level 2 NASDAQ data feed, you could actually see all the market makers and see their quotes. And you might want to make sure you're doing business with the person who has the best price. Now, not everybody needs to see all the market makers. So very test will know that the inside market or inside quote is the highest bid and the lowest ask. And if the customer is selling, he's going to get the low price, but he wants the highest of the low. If the customer is buying, he knows he's paying the high price, but he wants the highest of the low. Very testable. I say 15, 10, 15, 20. 5x8. And you say, Dean, we're buying 800 shares. I say, yeah, I changed my mind. They'll say on the test, a market maker fails to honor firm quote. This is a prohibited practice and I was backing away. Backing away. Okay, so we talked about most of this stuff. I hope you found this 90 minutes helpful for you. This is the Series 7 Mighty 90 or Series 7 and 90 minutes. I just want to throw a couple more test questions in there. You probably are familiar already with your U4. U4 is hello, U5 is goodbye. I would know that any amendments, any no answer on your U4 that becomes a yes answer, you have 30 days to actually, make that adjustment. Margin, I wouldn't worry about it at all. Maybe 3 or 4 questions, very, very lightly tested, but I would certainly know the $2,000 trick, right? If you buy less than 2,000, your initial transaction, SRO, you pay in full. 2 to 4, you pay 2. Over 4, you pay 50. Right? Definitely would know that. I would know the additional documentation to open a margin account, the credit agreement mandatory, the hypothecation agreement mandatory, loan consent optional. If you get calculations, initial setup and mark to marks, you just the classical margin equation. If you tell me that you missed your Series 7 because of margin, I'm going to say, what were your other, questions there, right? So, all right. If you have any questions about the Mighty 90, just go ahead, send it my way. I'm more than happy to help you with any questions you may have. And remember, inch by inch, your Series 7 is a cinch, yard by yard, your exam is hard. I'll see you. Hopefully, I'll have the Mighty 90 for your next exam available by the time you take it, whether it's a 63 or 66 or 65. Usually, that would be what you're up to next. All right, everybody. Bye-bye.